Linda Fox. I'm in the PhocusWire studio and I'm joined by Morgann Lesne, and he is a senior partner at Cambon Partners?
Founding partner.
Founding partner, thank you. Founding partner, welcome.
Co-founding partner to be here. Exactly.
Co-founding partner, we like to get these things right. So welcome to the studio.
Thank you, Linda.
It's been a while since you've come and sort of chatted to us about the market. General thoughts on M&A. We are seeing quite a lot of activity. It does tend to be those smaller acquisitions. So I just wanted to get your views on the market.
Yeah, we'll see. 2026 is a year with a lot of questions, which has caused a slowdown in M&A volumes and number of transactions. I'd say 25 was not a great year. We had like 22, 23, 24 nice years, then started to slow down in 25. Then 26 is we still see a bit of activity. Let's look at like what Expedia recently announced, the acquisition of CrowdRoller, which was a pretty massive acquisition, but it was, I'd say, unbrokered. It was like bilateral approach. So
their teams got
unsolicited approach. Expedia reached out and then wanted to expand into B2B. At least I thought they would, and then they decided to go after one target without waiting for the target to be ready to be on the market. So it's I'd say in this moment of uncertainty, I think there's obviously opportunities for buyers who want to have a long-term plan, which was the case of Expedia. I look at Airbnb also. They announced a big investment in WeRoad in Italy.
Yes.
So yeah, there's still a few things happening, but when you look at the volumes we had in 23 and 22, it has nothing to do with it.
It's not there yet.
So, but it might come back.
Yeah, I don't know. I feel maybe it's because I'm seeing lots of smaller. Sometimes I feel that some of the smaller activity, once that starts rolling, you get some of the bigger activity, but that's probably me just making up a scenario. But it just feels as if there's more activity. I don't know why. Just maybe there's more coming across my desk. I don't know.
No, you're right. There's still room for consolidation. So meaning you will still see a lot of smaller deals. Where regardless of the macroeconomic environment, because travel is characterized by fragmentation. Hyper fragmentation. There's so many small businesses out there. So if you want, and we know that it's about scale. Everything is about scale. So meaning at some point, small players must have as to join forces, become a bit bigger, and then eventually one day a big buyer will buy them. Yeah. But Expedia is not buying small things. Booking is not buying small things. They have to buy things that move the needle.
Sure. Often
people get it very wrong about am I sellable to these big boys? The bar is super high. The bar is very, very high. You need to be worth hundreds of millions in order to be interesting for these people.
Right. So you don't think that, you will remember those days of booking holdings going after those small boutique hotel tech companies, and there was 5 or 6. So
they failed.
Yeah, they did. They did fail. Yeah, they did. So I guess that's as good a reason as any is not to go for those smaller acquisitions.
But they fail not because they are bad. They're very good at what they do. But just like in order to be absorbed by a very big company, you need to have muscles, which is not always the case with small companies. They don't have muscles. It's normal. They are building bones and then muscles.
And you're not going to be nurtured necessarily in that big company environment.
Exactly.
So I wanted to pick up on 2 things you just said. One was that you that there was no broker involved in the Expedia deal. Is that common?
I'd say, players like Expedia, they know what they're doing, meaning, and they're also equipped, the M&A, the corporate dev team is made of people who've been investment bankers before. So they know how it works. I'd say, I understand why TowerBrook, which was one of the leading investors in CrowdRoller, decided not to go to market in 2026 because the market conditions were not good enough. So it could only be a preemptive situation that, potentially would have made them change their mind, which that what happened. I'd say in general, private equity, because we're talking about private equity, wanting to exit, they usually go through a process. Yes. They hire a banker, but I'd say in 2026, there's no rule. The rule is no rule.
Yeah. Okay. Good to know. And then because you've said now that CrowdRoller wasn't necessarily looking to be acquired. I guess I just sort of thought in my mind that CrowdRoller, because it was private equity, you really could be acquired at any time. Aren't you always ready?
True. Absolutely. But the theory and the reality.
Practice.
Practice. So theoretically, in theory, private equity should wait for good moments where you have good density of buyers. Okay, because obviously the company has to go well and in order to command a nice premium. But the reality is that you need a density of buyers in order to create what you call a climate or auction climate, right?
Yeah, you want to
because if you want to have if you want to push the price up, You need to have several people that are interested around the table, which is, a bit, the contrarian of like a preemptive approach. But I'm sure we'll see more and more of these because I don't see the market, although the conflict hopefully is over, is going to be over.
Yes, hopefully the MOU is going to hold.
Yeah. Certainly would. But I believe that 2026 is not going to be a very strong year in M&A. But we'll see those type of preemptive approach. I am myself on the buy side sometimes. I use that moment where people are full of questions to go directly to the target and try to trigger discussions.
Nice.
That's a good moment.
Yeah. When people aren't really expecting it, and you could propose something that perhaps they're not thinking of,
but then you need to find the adequate structure, the financial structure. You need to talk about earnout or price complement. Let's see how the business behave, but you have to serve a decent price up front, and then talk about synergies and what would be the value in 2, 3, 4 years down.
So would you say you're doing lots of that right now, what you've just described? Yeah. And particular sectors or all over? Or
within travel tech?
Yeah.
I'd say everything related to corporate travel.
Oh, interesting. Okay.
Yeah. Corporate travel, we see a lot of activity.
Yeah.
MICE as well.
Okay.
Groups, leisure, but a lot of B2B, I'd say. I'm more involved in B2B deals than in the rest.
Yeah.
Well,
that makes sense. B2C. Okay, now we are seeing these kind of groups in the news. And I suppose last year it was the kind of travel softs and those guys, and as is it Visit Group out of Sweden, they did some M&A. The name of the third company.
Juniper.
Thank you. Slips my mind. Constellation, Juniper. But then you're also seeing, the Muses and the Lighthouses also acquire, in a more sort of specialist way. So what's your view on those two dynamics in the market?
I think it's one dynamic.
You think it's one?
It's, I wouldn't say there are two groups. I'd say you've got one is more private equity backed. You mentioned TravelSoft, Visit Group. I'd say Constellation in a way backing Juniper. It's more private equity, private or public markets. And then on the other hand, you've like more VC growth style, Lighthouse and Muse and so for me, it's one group. It's just these people considering themselves as platforms.
Yes.
So buying stuff that are either very profitable, buying a good multiple of a profitable company, which is the case of like the first three, and then the rest is like more the Muse and Lighthouse buying smaller stuff. But more sometimes buying teams, features or like market shares, but not looking at doing big deals because there's also a difference between their capacity to fund acquisitions. So on the one hand, you've got profitable companies that have, I would say, not unlimited access to capital, but huge access to a huge pool of capital. Whereas the second group is a little more under pressure about like how to deploy capital. They raised a lot of money back in the days, but now it's more difficult for them to raise money. So I wouldn't see big transaction coming from these, the last.
No, they're more.
But I definitely see more coming from the first group.
Yeah, because it's interesting, isn't it? Because I find that the Junipers, I suppose I see the what they're buying is a little bit more disparate, one company from the other. Whereas I see what Muse is buying is to get bigger, tuck in AI,
Juniper is really building an ecosystem, for like air, hotel, cruise, you name it.
Yeah.
Whereas Muse is more like accommodation, power.
Yeah.
Power every single accommodation in the world. That's one thing, accommodation. But the market is so deep, so big that
and then Lighthouse has just been. It seems like it's buying all the individual pieces to create that operating system, which is interesting.
Exactly.
Yeah. Okay. So the current climate, interesting. Obviously, you're using it to your advantage. Is there a right time? Is there ever a wrong time? Is it always the right time? What's the view there?
Depending if you're a seller or a buyer, I would say in general, it's always the good time. When you're a very long-term person, it's always the good time. It's rather now than, in 1 or 2 years' time. Because if you project yourself in 20 years, what's the point in waiting 1 or 2 years before doing something that you think is important? So in general, I'd say it's always the right moment. But then you've got to make sure that you've got the right funding in place. So if you've got the right funding, you're unstoppable, I'd say. Whereas if you're a seller, it might be a little different because you need to be backed by good current trading. So you don't go to market if your current trading is not super rock solid. Then you look at how the markets behave. We saw public markets re-rating by 25%, say in the software and tech space. Today is not ideal to run a proper process. Okay, so I'd say it's never the perfect time to sell or buy, but I'd say depending if you're a long-term person, which sometimes not completely compatible with private equity investment cycles, like 5, 6, 7 years. But for me, as a banker, I would encourage everyone to go and consider buying a company now, but just measure your capacity to fund it.
Okay, interesting. We used to talk about crazy valuations, and we're talking 2-3 years ago. We don't talk about that anymore. Although you still hear it a little, people saying, "Oh, they value themselves too highly. We're not going to go after. We're not interested. The market's still too frothy." Whatever they say. Again, what's your view there?
Yeah, I think usually what commands a high valuation is the business plan.
Yeah.
So if you're able to buy, I don't know, a company at like 20, 30, 40 times its EBITDA, it really depends on its growth. Because if the company is growing 100% year over year, what you bought 1 year is probably worth 10 times the other year, the next year, which is fine, really. So there's a real correlation between the EBITDA multiple you can pay and the type of growth you can see. Meaning, but it's hard to predict that you will be keeping growing 100% year over year for the next 3, 4, 5 years.
Yeah.
That's where I think sometimes the projections were a bit optimistic in general, which led to high valuation. That's one factor. The other factor was that it was also pushed by private equity investment firms that wanted to enter a space believing that it will be growing forever at like 15-20% organic. Right. We in 2026, everyone can remark that it's harder than we expected. Yeah. So it's not like infinite growth. It's a market that will double in 10 years. But whatever you talk about,
3.
But there will be fluctuations.
Yeah.
So I think
so a sort of step level as opposed to
fluctuations.
Yeah. So I'm glad you mentioned private equity, because I don't know if you were in the coffee chat this morning with Chris Hemeter and Rod and Mario Guevara, but I heard that Chris was talking about how hard it is now to make investments, where to hedge your bets. It'll be more 10 checks, smaller checks as opposed to 5. And we've been hearing that for now at least a year, if not more, because of AI. Is that something we're going to hear for some time to come? Will it settle? What's going to happen?
Yeah, there's a lot of confusion now in the market because you don't know exactly what's investable or not. If you're a software company, what's your real value? Okay, because it's no longer your IP, it's no longer your code. It doesn't mean that it's worth nothing. It's just worth that it's what has value is the contractual relationship, the content, the uniqueness that you have, the data that you have, not necessarily the IP. So when from an investment perspective, from the investor perspective, it's hard to really understand what's the moat and what's something that is indestructible. Because I think what AI has put some light on is AI can destroy a lot of things.
Right.
But so you need to figure out what is indestructible. If you don't have the answer, don't go to market. If you don't have the answer, don't invest in this company. That's why there's a lot of confusion these days. And I'd say now in June 2026, we're much better off than we were in January 2026. Because in 2020, at the beginning of this year, you couldn't even pronounce the word of software company. Everyone would tell you you'd be dead.
Doomed.
Doomed.
Yeah. Yeah.
So now, people say, okay, now it's going to take more time. It's going to be more complex to disrupt.
Right.
But no, I can tell you there's a lot of confusion. Look at the number of deals that closed, whether it's M&A or financing. The number of down significantly.
Yeah. Yeah.
It will go up.
Yeah.
But it will take a few more months, I think.
Okay. So how has your kind of whole philosophy and strategy on investment changed, just even in the past, say, year?
I'd say I put more emphasis on consolidation. Mm-hmm. I do more deals that have a form of consolidation play.
So an ecosystem potentially.
Ecosystem or buying,
system.
Or market share, but definitely more than ever, not necessarily looking to back promising startups, but more to back or advise, build up strategies.
Okay.
That's more my thing. It's but for me, it's hard to predict what is going to be innovative. So instead of I don't have the answer to that question. The answer I have is that size will always matter.
Yeah.
So this is the only thing I can deal with for the time being.
Yeah. Okay. And where if I ask you, project forward a little while, and I don't like to go too far out because we just don't know, but say 6 to 12 months. What would you say? I mean, you said B2B before. What would you say? What will be the areas that you'll be kind of keeping an eye on?
Still B2B for sure.
Yeah.
B2B to C. I do believe that we'll see more and more non-travel brands entering the travel market, whether it's like loyalty programs, personal finance brands, or retail brands, or loyalty. So I'd say we'll see more and more of that, and we'll see airlines as well. I think the fact that Expedia bought Cartroller is not just because adding a B2B capacity in car rentals. It's more the opportunity to be connected to 100 airlines with a channel to sell ancillaries to airlines. So I wouldn't be surprised to see more and more of that market shifting to airlines.
Yeah. Because, I mean, that's, I hate using this terminology like connected trip, but that is got to be the game, right?
Absolutely.
Yeah. Thank you so much for joining us. Appreciate it.
Pleasure, Linda.